Most people think the wealthy possess some secret crystal ball, some insider network that whispers tomorrow's winning stocks into their ears at private dinners. They're wrong. The fundamental skill that separates billionaires from the masses isn't prescience, and it certainly isn't luck, it's pattern recognition. The ability to see what's invisible to everyone else, to read the signals hidden in plain sight, to understand that history doesn't repeat itself, but it rhymes with such precision that you can position yourself years before the inevitable unfolds. Michael Rubin, the billionaire CEO of Fanatics, put it perfectly when he said pattern recognition is everything, that he uses it in everything he does. And here's what most people will never understand. This isn't mysticism. This isn't gut feeling. This is a disciplined, learnable system that you can master starting today. Let me be direct with you. If you're watching this video right now, you're already ahead of 99% of people who will never even question why they keep missing opportunities that seem obvious in hindsight. But here's the reality. Watching isn't enough. The people who actually transform their wealth are the ones who commit to the process, who take action on what they learn, who signal to themselves that they're serious about this path. So before we go any further, I need you to do something. Hit that like button right now, not later, not maybe, right now. Because that simple action tells your brain you're invested in this knowledge. Then subscribe to this channel and turn on notifications, because what I'm about to share with you over the next 30 minutes is just the beginning. The strategies I'm revealing next week will build directly on this foundation, and if you miss them, you'll be trying to assemble a puzzle with missing pieces. This isn't optional if you're serious about wealth. This is the prerequisite. Do it now. Now let's talk about what separates you from the investors who saw Amazon at $18, Bitcoin at $300, real estate in Phoenix in 2009. It wasn't information. That information was available to everyone. It was the ability to recognize the pattern, to understand the cycle, to see the convergence of signals that made the outcome not just possible, but probable. And I'm going to show you exactly how they did it. Let me take you back to the summer of 1992. George Soros, already a billionaire, is watching currency markets with an intensity that would seem obsessive to most people. Britain is in a deep recession. Unemployment is climbing. Interest rates are painfully high because the country is trying to maintain its currency's value within something called the European exchange rate mechanism. Meanwhile, Germany is booming after reunification, their economy is overheating, and their central bank is raising interest rates to cool things down. Two economies moving in completely opposite directions, yet artificially linked by a currency agreement that's trying to hold the British pound at a level that makes no economic sense. Now, most traders saw this situation and thought, well, that's interesting, but the British government will defend their currency. They have the Bank of England. They have reserves, they'll make it work. But Soros wasn't like most traders. He had studied this pattern before. He had seen it in multiple historical examples. A currency held artificially high through government intervention eventually breaks. It's not a question of if, it's a question of when. The mechanics are simple and brutal. To keep the pound from falling, the British government has to spend its foreign currency reserves buying pounds. But those reserves are finite. Eventually they run out, and when they do, the currency collapses. Soros began quietly building a position. He started shorting the pound, betting against it, accumulating what would eventually become a $1.5 billion position. Then he waited. He watched for the signal that would confirm the pattern was accelerating. And it came. German officials made a public statement suggesting that a realignment within the exchange rate mechanism was possible. To most people, this was just political noise. To Soros, it was the confirmation. The dam was cracking. He escalated his bet to $10 billion. On September 16, 1992, a day that became known as Black Wednesday, the British pound collapsed. It fell 15% against the German mark and 25% against the US dollar in a single day. The British government spent billions trying to defend the currency before finally admitting defeat and withdrawing from the exchange rate mechanism. And Soros walked away with approximately $1 billion in profit. Now, here's what you need to understand about this story. Soros didn't get lucky. He didn't have insider information. He recognized a pattern that had played out multiple times throughout monetary history. He understood the mechanics of how that pattern resolves, and he positioned himself accordingly. This is the first case study I want you to absorb because it demonstrates something critical. The wealthy don't predict random events. They identify situations where the outcome is mechanically inevitable once certain conditions are met, and then they wait for those conditions to appear. And Soros didn't stop there. In January 1997, months before the Asian financial crisis became headline news, he bet $1 billion against the Thai baht. Same pattern, currency overvalued, credit structures unsustainable, government trying to defend something that couldn't be defended. The crisis erupted exactly as the pattern predicted. Then, in 2013 and 2014, he recognized that Japanese Prime Minister Shinzo Abe's monetary easing policy would weaken the yen while strengthening Japanese stocks. Another $1 billion in profit from recognizing a predictable policy pattern. 3 different situations, 3 different countries, 3 different decades. Same underlying pattern, same mechanical inevitability, same massive profit for those who could see it. But let's go deeper, because currency speculation is just one application of pattern recognition. The real power comes when you understand the 3 core mechanisms that wealthy investors use to anticipate market shifts with remarkable accuracy. The first mechanism is understanding narratives and how they reshape reality. Modern research into something called narrative economics shows that markets aren't just driven by numbers, they're driven by stories. And not just any stories, but specific narratives that accumulate intensity and spread through financial media. When you analyze financial news reports using textual analysis, you discover something fascinating. Spikes in the intensity of market narratives align perfectly with structural changes in stock returns and volatility. The wealthy aren't just reading these stories for entertainment. They're tracking which narratives are gaining momentum, which ones are reshaping investor behavior, which ones will become self-fulfilling prophecies. When wealthy investors looked at Valeant Pharmaceuticals, which is now called Bausch Health, they didn't just see a company with impressive current metrics. They saw a business model they had encountered before in their mental database of corporate failures. They pattern-matched against dozens of previous cases where companies used aggressive acquisition strategies and accounting practices to create the illusion of growth. The pattern was there, clear as day to those who had studied it, and sure enough, Valeant collapsed exactly as that pattern predicted. The second mechanism is understanding long-term cycles. And I want to be very specific about this because it's where most people's understanding completely falls apart. Economic cycles are not random. They're driven by human nature and credit dynamics, and they follow repeating patterns with shocking precision. Ray Dalio, who used this understanding to sidestep the 2008 financial crisis, while most investors were destroyed, describes the economy as working like a machine. A predictable, mechanical system driven by 3 forces: productivity growth, short-term debt cycles that run 5 to 8 years, and long-term debt cycles that run 75 to 100 years. Here's how the machine works. When credit is easily available, people borrow and spend. Spending increases, prices rise, the economy expands. This is the expansion phase of the cycle. Eventually, debt accumulates to the point where people have to cut spending to service their debts. When that happens, spending collapses, prices fall, recession occurs. This is the contraction phase. Central banks can usually fix this by lowering interest rates, making it easier to borrow again. But here's the critical insight. When interest rates are already low, that mechanism breaks down. You can't lower rates below 0, at least not easily. When that happens, you're in what Dalio calls a long-term debt cycle crisis. The accumulated debt is so massive that the system requires a major reset. Dalio didn't predict the 2008 crisis because he had a crystal ball. He predicted it because he understood this mechanical system, and he could see that all the components were aligned for a long-term debt cycle reset. Credit spreads were too tight. Debt levels were astronomical. Housing prices had disconnected from fundamentals, and interest rates were already low with no room for traditional monetary policy fixes. The pattern was screaming that a crisis was inevitable. But cycles operate at multiple timescales, and this is where it gets really interesting. Back in 1862, an economist named Carl Juglar identified a fundamental cycle in economic activity. an 8 to 11-year rhythm of expansion and contraction. That pattern still appears in modern market data. It never stopped. Then you have longer cycles. William Gann, a legendary investor, identified master cycles of 100 years, 90 years, 60 years, 52 years, 45 years, and 30 years. And he used these relationships to issue forecasts that held up over time with remarkable accuracy. Contemporary analysis shows something stunning. The S&P 500 from 2022 to 2025 aligns with 60-year historical market patterns with uncanny precision. Specific years like 2025 mirror previous inflection points from 1980 and 1998. When wealthy investors zoom out to examine these multi-decade cycles, they're identifying key inflection points, moments when regime shifts in macroeconomic policy, liquidity conditions, technology adoption, and sector fundamentals all align into new equilibrium states. The third mechanism is what I call the Varian Rule, named after Hal Varian, Google's chief economist. He articulated something powerful. What rich people have today, middle-income people will have in 10 years, and poor people will have in an additional decade. This isn't just observation, it's a predictive framework. When venture capitalists observed wealthy individuals adopting personal trainers, cosmetic procedures, and boutique experiences in the late 20th century, they didn't just admire the lifestyle. They recognized an inflection point. They understood that as these services became more accessible through technology and scale, entire industries would emerge. This principle applies everywhere. The private education the wealthy purchase today signals where educational technology will disrupt tomorrow. The healthcare they access reveals where medical innovation will flow. The travel experiences they curate show where the hospitality industry will evolve. If you want to know where consumer spending and technological disruption will eventually flow, watch what the wealthy are buying right now. Now I want you to pause for a second and think about what I just shared with you. Narratives that reshape reality, cycles that repeat with mechanical precision, luxury consumption that predicts mass market trends. These aren't abstract concepts, these are tools. And if you're starting to see how powerful these tools are, if you're beginning to understand why the wealthy seem to always be positioned ahead of the crowd, then you need to do something right now. Drop a comment below and tell me which of these three mechanisms surprised you most. Tell me where you're seeing patterns in your own industry or investments. Because here's the truth. Engaging with this material, articulating what you're learning, that's how it moves from passive consumption to active mastery. Don't just watch, participate. Your comment might be exactly what another viewer needs to see to connect the dots. Do it now. Let me show you how this works in practice with another case study. Peter Lynch, one of the most successful mutual fund managers in history, ran the Magellan Fund at Fidelity from 1977 to 1990. During that period, he averaged a 29% annual return. 29%. If you had invested $10,000 with him at the start and left it alone, you'd have ended up with over $280,000. Lynch didn't claim to predict short-term market movements. In fact, he openly admitted that trying to time the market was futile. But he recognized a long-term pattern that most investors completely overlook. Corporate profits have historically increased by approximately 8% annually. This means corporate profits double roughly every 9 years. And if profits double every 9 years, Lynch argued, the stock market should also double roughly every 9 years because equity prices fundamentally follow earnings growth over long periods. Now, this seems simple, maybe even obvious when I say it like this. But here's why most people miss it. They get distracted by short-term volatility. They see the market drop 15% in a month and panic. They see it surge 20% in a quarter and think they've missed the opportunity. But Lynch understood that while unexpected events cause short-term noise, the deeper pattern, the relationship between productivity, earnings, and valuations, remains remarkably reliable over decades. This allowed Lynch to do something most investors can't. He could look at market levels and identify when prices represented genuine departures from the fundamental pattern. When the market traded below the level justified by long-term earnings growth, he knew it was undervalued, regardless of current sentiment. When it traded above that level, he knew it was overvalued regardless of current euphoria. He positioned his investments around the most probable long-term trajectory, while acknowledging and ignoring short-term noise. But pattern recognition becomes even more powerful when you combine multiple signal systems. Let me take you to October 1987. Paul Tudor Jones, a hedge fund manager, was watching the market with growing concern. The stock market had surged dramatically through the first 9 months of the year. Everyone was euphoric. Money was pouring in. But Jones noticed something that bothered him. He used technical analysis, studying price charts and patterns. He used volume analysis, tracking how many shares were trading. He used momentum indicators, measuring the speed and strength of price movements. And he looked at fundamental data, examining bond yields and corporate earnings. And all of these systems, every single one, was showing the same thing. The market had surged too quickly relative to underlying economic reality. Prices had disconnected from fundamentals. Jones also studied the 200-day moving average, a simple but powerful tool that smooths out short-term noise to reveal underlying trends. When prices trade consistently above this average, it indicates a strong uptrend. When they break below it, especially with increasing volume, it signals that the trend may be reversing. In October 1987, all of Jones's signal systems aligned. Technical patterns showed exhaustion. Volume confirmed weakness. Momentum was declining. Fundamentals showed overvaluation. And multiple indicators suggested excessive risk had built up in the system. So Jones positioned himself for a reversal. He didn't just reduce his long positions, he actively bet against the market. On October 19, 1987, Black Monday, the stock market crashed. The Dow Jones Industrial Average fell 22% in a single day. It remains the largest single-day percentage decline in stock market history. Investors around the world were decimated. But Paul Tudor Jones tripled his capital. He made approximately $100 million because he recognized a pattern across multiple signal systems and took action before it resolved. What distinguishes Jones's approach from gambling is that he didn't rely on a single signal. He combined price action, volume confirmation, momentum indicators, and macroeconomic fundamentals into a coherent pattern that indicated excessive risk. When these signals converged, he had confidence to act. The crash occurred when the market's internal structure, the pattern he had recognized, finally reasserted itself. Now let's talk about Stanley Druckenmiller, who worked with George Soros and then ran his own fund. Druckenmiller has stated that the inside of the stock market is the best economic predictor he's ever encountered. What does that mean? He identifies industries and companies so tethered to economic cycles that they provide reliable signals about where the rest of the economy is heading. Sectors like trucking and retail are extremely sensitive to demand patterns. When trucking volumes decline, it signals that goods aren't moving, which means consumption is falling, which means a broader economic slowdown is coming. When retail same-store sales weaken, it confirms that consumers are pulling back. But here's where Druckenmiller's pattern recognition gets sophisticated. For cyclical industries, he normalizes earnings around the cycle rather than using current price-to-earnings ratios. Why? Because cyclical stocks look cheapest at peaks and most expensive at bottoms. When a cyclical company is at the peak of its cycle, earnings are temporarily inflated, making the PE ratio look low and attractive. But those earnings are about to collapse. Conversely, at the bottom of the cycle, earnings are depressed, making the PE ratio look high and unattractive. But those earnings are about to recover, so Druckenmiller watches for capacity reductions. When an industry starts cutting production and closing plants, this signals that the bottom is near and pricing power will eventually return. He positions investments 18 to 24 months ahead of when the recovery will become obvious to the broader market. By the time everyone else recognizes the turnaround, he's already captured most of the gain. This reveals something critical. Wealthy investors don't just recognize patterns in what exists. They recognize patterns in what's about to change by reading the early signals of structural shifts. Let me give you one more case study, and this one's important because it shows how pattern recognition applies to individual companies, not just macro trends. Kali Khan, with a net worth exceeding $15 billion, built his fortune through activist investing. But his approach is built on recognizing a repeating pattern, Undervalued assets with fixable problems represent the highest return opportunities. When Ikan looks at a company, he's not just analyzing current financials. He's asking, is this asset trading below its intrinsic value? Is the management poor or misaligned? Can these problems be fixed? And if the answer to all three questions is yes, he recognizes the pattern. This is an opportunity. In 2012, Netflix was struggling. The stock was at its 52-week low. The company had made strategic mistakes, and investors had lost confidence. Most people saw a failing company. Ikan saw a pattern he had encountered dozens of times. A fundamentally strong business temporarily mispriced due to market sentiment. He acquired a 10% stake for $321 million. The announcement alone caused shares to surge 14%, a phenomenon now known as the Ikan lift. His investment eventually grew to over $1.9 billion. This wasn't luck. It was pattern recognition applied to identifying when market sentiment has become disconnected from fundamental value. Ikan had seen this pattern so many times that he could immediately recognize the characteristics: strong underlying business model, temporary problems creating negative sentiment, market overreacting and pushing price below intrinsic value, and a clear path to fixing the problems. Now I've walked you through 5 major case studies: Soros and currency devaluation, Dalio and economic machine logic, Lynch and earnings growth patterns, Jones and the '87 crash, Ikan and undervalued inefficiencies. 5 different investors, 5 different strategies, 5 different asset classes. But notice the common thread. They all used pattern recognition. They all studied history. They all understood cycles. They all waited for multiple signals to converge. And they all positioned themselves before the pattern resolved. So the question becomes, how do you develop this skill? How do you move from being someone who watches opportunities pass by to someone who sees them coming? The framework has 3 steps, and I want you to understand that this isn't theoretical. This is the actual process wealthy investors use. Step 1. Study long-term cycles and historical precedents. This isn't casual reading. This is deliberate data collection. When Ray Dalio analyzes market crashes, he's not satisfying intellectual curiosity. He's building a mental library of precedents that allows him to recognize when similar patterns are forming. When Paul Tudor Jones studies previous market tops, he's cataloging the specific combination of signals that appeared before reversals. You need to do the same thing. Study how previous technological booms unfolded. Look at railroads in the 1800s, electrification in the early 1900s, the internet in the late 90s, mobile computing in the 2000s. Notice the pattern: initial investment euphoria, apparent overbuilding, market crash, eventual consolidation into genuine transformation. Every single one followed this path. The pattern shows that transformative technologies consistently outpace short-term valuations before eventually justifying the long-term vision. This means when you see massive investment flowing into artificial intelligence right now, you're not guessing whether it's a bubble or the real thing. You're recognizing where you are in a well-established cycle. You understand that there will be overbuilding, there will be corrections, but the long-term transformation is inevitable because that's how the pattern works. Step 2. Zoom out to identify repeating human patterns. The most sophisticated pattern recognition goes beyond financial data to understand human psychology and behavior. Behavioral finance research shows that markets cycle through periods of fear, euphoria, regret, and renewal with surprising regularity. There's even a 7-year cycle that appears in marriages, careers, corporate performance, and yes, markets. Expansion phases breed complacency, which eventually triggers correction and renewal. Wealthy investors recognize these patterns in human nature itself. Overconfidence builds during prolonged optimism. Herd behavior concentrates capital into trending sectors. Panic accompanies sudden awareness of risk. By understanding these psychological patterns, they anticipate market emotions before most participants recognize them. You see this playing out right now in every market cycle. When real estate prices climb for 5 straight years, you can predict with near certainty that sentiment will shift from cautious to euphoric. First-time buyers will stretch their budgets. Investors will accept lower yields. Standards will loosen. And then, inevitably, something will trigger awareness that prices have overextended. The pattern is so reliable that you can position yourself accordingly. Step 3. Invest early in inevitable trends. The Varian Rule captures this. Watch what wealthy people do first. Recognize which behaviors and products will eventually scale, and position investments before those trends become consensus. But you have to distinguish between fads and genuine trends. Genuine trends have specific characteristics. They solve real problems. They align with long-term human incentives. And they follow predictable adoption curves. Wealthy investors recognize these characteristics early. When personal wealth management emerged, investors understood it wasn't a passing fad. It was an inevitable consequence of growing wealth concentration. They positioned investments in wealth management platforms and services years before the broader market recognized the trend. Similarly, when the technology adoption curve shows artificial intelligence moving from innovators and early adopters into the early majority phase, informed investors recognize this as a predictable inflection point. This is the moment when adoption accelerates dramatically and previously dismissed applications suddenly become viable. Now here's the critical distinction that separates successful pattern recognition from superstition. You have to distinguish between true signals and noise. Markets are flooded with data, patterns, and correlations that seem meaningful but have zero predictive power. Researchers have shown that butter production in the US and Bangladesh, sheep populations, and cheese production can statistically predict stock market movements. But this correlation has absolutely no causal validity. It's meaningless noise. The wealthy develop filters to eliminate this noise. Real patterns have causal logic. When Soros identified the British pound's weakness, it wasn't because of a statistical anomaly. It was because of a fundamental mechanical problem. The currency was overvalued relative to economic fundamentals, and the government lacked sufficient reserves to defend it indefinitely. The outcome was mechanically inevitable once those conditions were present. Real signals converge. Paul Tudor Jones didn't bet on the '87 crash based on one indicator. He waited for technical, volume, momentum, and macroeconomic fundamentals to align in a way that indicated excessive risk, disconnected from reality. One signal can be noise. Multiple independent signals converging on the same conclusion represent a genuine pattern. Real trends align with incentives. Wealth management services aren't universal because of random chance. They're inevitable because as wealth concentrates, wealthy individuals need specialized services to manage complexity. This isn't a prediction requiring belief. It's pattern recognition applied to human incentives. When you understand incentives, you understand behavior. When you understand behavior, you understand where money will flow. And this brings me to the psychological foundation that determines whether you'll actually apply this or just admire it from a distance. Most investors fail to recognize patterns because of cognitive limitations and emotional biases. Uncertainty creates anxiety. Anxiety compels people to rush to conclusions rather than patiently study cycles. And here's the paradox. Humans are so talented at pattern recognition that they often see patterns where none exist. This has led countless investors to rely on spurious correlations rather than genuine causal relationships. The wealthy overcome this through institutional discipline. They develop systematic processes for pattern recognition rather than relying on intuition. Dalio created written principles for understanding economic mechanics. Druckenmiller developed a framework for identifying cyclical inflection points. Econ built processes for deep due diligence that reveal when market prices diverge from intrinsic value. You need to do the same. You can't rely on gut feeling or occasional insights. You need a system. Write down the patterns you're tracking. Define the specific signals that confirm those patterns. Establish criteria for what constitutes convergence. And most importantly, maintain the discipline to wait for confirmation before acting. The most sophisticated wealth builders recognize that inflection points emerge when multiple converging signals indicate a regime shift. These signals include macro policy trajectory. when central banks signal major policy shifts and interest rate environments change. Liquidity regime changes, when private market fundraising accelerates or suddenly tightens, signaling whether capital is flowing toward risk or retreating toward safety. And sector-specific catalysts, when technologies or market structures are genuinely shifting, producing early signals in adoption rates, customer retention, and unit economics. By institutionalizing a framework that monitors these signal clusters simultaneously, sophisticated investors don't predict the future. They detect when structural changes are already beginning. They position themselves not for what might happen, but for what becomes increasingly probable as multiple confirming signals emerge. Let me bring this together with a contemporary example that shows how all three mechanisms converge. Right now, as I'm recording this, we're watching a major shift in artificial intelligence adoption. The narrative mechanism shows that AI has moved from niche technology discussion to mainstream business imperative. Every earnings call, every strategic plan, every capital allocation decision now includes AI as a central component. That narrative intensity spike signals a structural change in how companies operate and compete. The cycle mechanism shows that we're in the infrastructure build-out phase of a major technological transformation. This is analogous to the railroad boom of the 1800s, the electrification of the 1920s, or the internet infrastructure build-out of the 90s. The pattern is identical: massive capital investment, apparent overbuilding, eventual consolidation, and long-term transformation. Understanding where we are in this cycle tells you that near-term volatility is inevitable, but the long-term trend is unstoppable. The Varian Rule mechanism shows that wealthy individuals and large corporations adopted AI applications years ago, investing heavily in machine learning systems, predictive analytics, and automated decision-making. Those applications are now scaling to mid-market companies and will eventually reach small businesses and consumers. The pattern is clear. What seemed like luxury or competitive advantage 5 years ago is becoming standard infrastructure. When you layer these three mechanisms together, you get a high-conviction view. Artificial intelligence represents a genuine structural shift, not a temporary fad. There will be winners and losers, there will be overvaluation and correction, but the fundamental transformation is inevitable because all three pattern systems confirm it. This is how the wealthy think. They don't react to headlines. They don't chase momentum. They recognize patterns. They understand cycles. They watch for convergence, and they position themselves accordingly. Now let me address something directly. Some of you watching this are thinking, this sounds great, but I'm not a billionaire. I don't have access to the same information, the same research teams, the same capital. And you're right about the resources, but you're wrong about the conclusion. Pattern recognition isn't about resources. It's about discipline and systematic thinking. Soros didn't have a research team when he started. Dalio didn't have institutional backing when he developed his principles. Lynch didn't have artificial intelligence or big data. What they had was commitment to studying history, discipline to wait for pattern confirmation, and courage to act when the signals aligned. You have access to more information right now than they had in their entire careers. You can study every market cycle, every corporate failure, every policy shift in human history. The information is available. The question is whether you'll do the work to build the mental library of patterns. And here's what most people will never do. They'll watch this video, they'll think it's interesting, they'll agree with everything I've said, and then they'll do nothing. They'll go back to reacting to headlines, chasing trends after they're obvious, and wondering why they're always late to opportunities. Don't be that person. If you're serious about mastering pattern recognition, you need to commit to the process. Start studying long-term cycles today. Pick one historical boom and bust cycle, doesn't matter which one, and study it in detail. Understand what signals appeared at each phase. Recognize the psychological patterns that drove behavior. Build that mental library. Start tracking current narratives, not just reading headlines, but analyzing which stories are gaining intensity, which ones are reshaping investor behavior, which ones are becoming self-fulfilling prophecies. Keep a journal, write down your observations, review them quarterly to see which patterns held up. Start watching what wealthy people and early adopters are doing. not for lifestyle voyeurism, but as predictive data. When you see concentrated adoption of specific technologies, services, or behaviors among the wealthy, ask yourself, is this a fad or a genuine trend? Does it solve a real problem? Does it align with human incentives? Will it scale? And most importantly, develop the discipline to wait for convergence. One signal is interesting. 2 signals are suggestive. 3 or more independent signals pointing to the same conclusion represent a genuine pattern worth acting on. The wealthy who successfully navigate markets and build lasting wealth aren't mystics or fortune tellers. They're disciplined practitioners of pattern recognition who understand that markets are driven by repeating cycles rooted in human nature and credit mechanics, not random chaos. That early adopters and the wealthy reveal inevitable trends through their consumption and investment choices. That signals exist if you know where to look, in debt levels, adoption curves, capacity changes, and sentiment extremes. That convergence of multiple signals indicates genuine inflection points rather than noise, and that most people miss these patterns because they look too closely at daily noise and lack the patience to study long-term cycles. The rich don't predict the future. They observe the present more carefully, study the past more thoroughly, understand the mechanics more deeply, and recognize the patterns others dismiss as invisible until they become undeniable. And here's my final challenge to you. The difference between where you are now and where you want to be isn't luck, it isn't connections, it isn't even capital. It's pattern recognition. It's seeing what's coming before it arrives. Starting today, you have a choice. You can continue reacting to markets, or you can start anticipating them. You can keep missing opportunities, or you can position yourself ahead of them. You can watch from the sidelines, or you can study the game until you master it. The patterns are there, the cycles are repeating, the signals are visible. The only question is whether you'll develop the discipline to recognize them. If you found value in what I shared today, if you're starting to see markets differently, if you're ready to commit to this path, then make sure you're subscribed to this channel because everything I'm building here is designed to accelerate your pattern recognition abilities. Next week, I'm breaking down specific sectors where multiple signals are converging right now, revealing inflection points that most investors won't recognize for another year or two. You don't want to miss that. The wealthy aren't smarter than you. They just see patterns you haven't learned to recognize yet. Change that, and you change everything.